There are several types of stocks. For example, Berkshire Hathaway has two share classes, two types of stock, a Class A common stock and a Class B common stock. And Berkshire Hathaway isn't alone in having a multi-class stock structure. Facebook has three classes, Google has two classes, Under Armour has two classes, so a multiple share class setup is not unusual. So why do companies have multiple classes of common stock? The most common reason is voting control. For example, Facebook has Class A shares, Class B shares, and now Class C shares. The Class C shares, let's try saying that 3 times really quickly. Class C shares have economic rights but no voting. They're entitled to dividends, but they have no voting power. That is, they cannot vote, for example, for the board of directors. The Class B shares have extra voting power, and the Class A shares have voting power, but not as much voting power as the Class B shares. Guess who owns the Class B shares with the most voting power? That's right, the founder CEO Mark Zuckerberg. Berkshire Hathaway's dual class structure is more tied to the actual share prices of the stock. So for example, if we look at Berkshire Hathaway's Class B stock, we see it trades for about $169 a share. And if we look at the Class A stock, this stock has never went through a stock split. So all earnings have been reinvested back into the company. And as you can see, the price per share is $253,000. So the Class B shares are a fraction of the value of Class A shares. We'll get back to that momentarily. But the two primary types of stock are common and preferred stock. So the Berkshire Hathaway Class A and Class B, those were both common stocks. And common stocks holders, as we've discussed previously, are sometimes referred to as the residual owners or the residual claimants of the firm, and they're the true owners of the firm. They only get paid after all of their claims on income and assets have been satisfied. As a purchaser of a bond, you are assured, at least reasonably so, that you're going to receive the cash flows that you've been promised. Equity holders, common stock holders, are only assured of one thing, that they cannot lose any more than they have invested in the firm. Because of their uncertain position, common stock holders expect to be compensated with adequate dividends and ultimately capital gains. In other words, an increase in the share price of the firm. Common stock can be privately owned either by an individual investor or a small group investor. It can be publicly owned by a wide group of investors as well. All companies are typically privately owned, and the stocks in private companies are generally not traded, and if they are traded, the transactions tend to be among private investors and will very often require the firm's consent. Publicly owned corporations, on the other hand, tend to be quite large, and their shares are generally actively traded in stock markets, whether the broker or dealer market. From an accounting perspective, we have 4 different types of common stocks. We have the common stocks that are authorized. We call these the authorized shares. And these are the shares of common stock that a firm's corporate charter allows it to issue. Outstanding shares are the number of shares that are actually outstanding held by investors. Now, these investors could be individuals, private individuals. They could be public pension funds. So the investors that own the outstanding shares, they can be public or private investors. Treasury stock are issued shares of common stock that's held by the firm. And very often these shares have been repurchased. So for example, the firm may repurchase its own common stock if it thinks its common stock is undervalued. And that share repurchase is a way for a company to pay out some of its gains. And finally, the issued shares, these are the shares of common stock that have been put into circulation. So the issued shares is equal to the outstanding shares plus treasury stock. Looking to the notes that accompany the financial statements for Berkshire Hathaway, we can see that in December of 2015 for the Class A shares, the Class A shares had a $5 par value. That's an accounting value when they were first issued. And there were 1.65 million shares authorized. And out of that 1.65 million that are authorized, there were 820,000 shares issued, of which the company had 11,680 shares in treasury for a total outstanding number of shares of 808,422. We can look over at the Class B, and we can see the par value is much, much smaller. And there were 3.225 billion shares authorized, and of that there were about 1.2 billion shares issued, about 1.4 million shares in treasury, for a total outstanding number of shares of 1.2 million. And if we look here to the notes that accompany the financial statement, these will always, for all companies, these notes will include this. It says that Class A common shares are entitled to 1 vote per share. Class B common stock possesses dividend and distribution rights equal to 1/1500th of Class A common stock, and each Class B common share possesses voting rights equal to 1/10,000th of the voting rights of a Class A share. So we can see why, from before, why the Class A shares were $253,000 per share, and the Class B shares were only $169 per share, because a Class B share only has an economic value of 1/1500th of a Class A share, and only 1/10,000th the voting rights of a Class A share. So quick concept check, true or false: unlike creditors, equity holders are owners of the firm.